Hey everyone, welcome back to Finance Friday, another special edition of Money Girl, where I answer your burning money questions. Today, I've got 3 excellent questions about reducing taxes and saving more money. I think you're going to love it. The first is from Carrie, who says, "Love your podcast. Can you clarify whether investing in a Roth IRA and I-bonds helps your taxes by reducing your taxable income? Or are pre-tax retirement assets, such as a 401k, the only way to bring your taxable income down?" The second comes from Jenny, who says, "I love your podcast. My fiance and I both qualify to contribute to our Roth IRAs. Once we get married, can we still contribute to them if we file taxes separately? Or do we have to file jointly?" And number 3 comes from Lisa F. from Houston, Texas, who says, love your podcasts. Thanks so much for being a wonderful, informative resource for everyone, but especially for women. I'm about to be a retired school teacher and must stretch my pennies. Once I spend all my flexible spending account, or FSA funds, what medical expenses can I deduct on my tax return? Thank you so much for your kind words and your questions, Carrie, Jenny, and Lisa. I'm going to answer them today so you have more clarity on terrific ways to reduce your taxes and keep a lot more of your hard-earned money. Welcome back, everyone, and thanks for joining me. I'm Laura Adams, an author, financial spokesperson, money speaker, founder of the Money Stack newsletter, and writer and host of the Money Girl podcast with 43 million downloads. If you're not already subscribed, go ahead and do that. That's the best way to never miss an episode. We've got a Wednesday show and a Friday show. This is the Friday show with the Q&A format. I would love to answer your question here. So you can send it to me via email on my contact page at lauradadams.com. You can also just send me a voice message. It's super easy. You just call 302-364-0308. And when you visit lauradadams.com, that's where you can subscribe to The Money Stack. It's a free newsletter that goes out 2 to 3 times a month. I would love to see you on the list, and I think you'll love all the great information and kind of behind the scenes stuff that I share there. All right, so let's talk first about Carrie's question. I think at the heart of it, she's asking which investments or accounts help reduce your taxes. So let's review how several tax-advantaged accounts work to cut your tax liability. If you've been listening to the show for any length of time, you've definitely heard me talk about traditional retirement accounts. So these are things like a traditional 401k, traditional 403b, or a traditional IRA. All of these require you to contribute money on a pre-tax basis. So that means those contributions help you. They reduce your taxable income in the current year. For instance, let's say you earn $60,000 and you contribute $7,000 to a traditional IRA. That would reduce your taxable income down to $53,000. So there's $7,000 that you're not paying tax on in the current year. But I do want to say, if you or a spouse contribute to a traditional workplace retirement plan like a 401k or 403b, and you contribute to a traditional IRA in the same year, some or all of your IRA contributions may not be tax deductible, depending on your income. And I've done a podcast called 6 Rules for Contributing to an IRA and a 401k in the same year. So if you want to learn more about that, definitely go back in the archive and have a listen to that show. With a traditional retirement account, your contributions and investment earnings get taxed as ordinary income when you take withdrawals. So, for most people, this is going to be in retirement. Making withdrawals before the age of 59 and a half means you would be subject to income tax plus an additional 10% penalty. So with the traditional retirement accounts, you're not escaping taxes, but you are deferring them to a later date. And you must take annual required minimum distributions, or RMDs, from traditional retirement accounts, starting at age 72 or 73, based on your life expectancy and the account balance. Now, the other primary type of tax advantage retirement account that you hear me talk about a lot is a Roth. So this could be a Roth 401k, a Roth 403b, or a Roth IRA. Your contributions with a Roth account are made on an after-tax basis. So that means they're non-deductible. For instance, if you earn $60,000 and you contribute $7,000 to a Roth IRA, your taxable income is $60,000. So those contributions to a Roth don't reduce your taxable income for the year. So while that might seem like a disadvantage, and in some cases it is if you need a tax deduction in the current year, but the benefits come later. So with a Roth account, the investment growth is never taxed after age 59 and a half. So that means your Roth withdrawals are entirely tax-free. Plus, there are no required minimum distributions with a Roth. So skipping taxes on Roth investment earnings could save you a massive amount. However, the Roth IRA does have an annual income limit, and I'll talk about that in a moment. Like a traditional account, early withdrawals of untaxed earnings from a Roth before age 59 and a half would be subject to income tax plus a 10% penalty. But your original contributions can be withdrawn tax and penalty free from a Roth IRA at any time, or any Roth at any time. And in addition to traditional and Roth retirement accounts, there are other tax-advantaged accounts that can help you reduce your taxes. For example, contributions to a health savings account, or HSA, are tax-deductible, reducing taxes. Withdrawals from an HSA to pay qualified medical expenses are entirely tax-free. However, you must be enrolled in an HSA-eligible health plan to contribute to an HSA. And you could purchase the policy through an employer or as an individual. In addition to a retirement plan, your employer may offer other benefits that reduce your taxable income, like a flexible spending account, or FSA, and I'll talk a little bit more about that in a moment. Carrie also asked about I-bonds. So these are a U.S. Treasury bond designed to protect investments from inflation. They have an interest rate that adjusts every 6 months. With an I-bond, your earnings are exempt from state and local taxes, but not from federal income taxes. However, you can defer taxation and report the earnings when you redeem or cash out a bond in the future. And you can purchase up to $10,000 of electronic I-bonds per year, and you may be able to buy an additional $5,000 of I-bonds using a tax refund. I-bonds may pay higher interest rates than savings accounts or CDs, but they do come with a penalty if you cash them out early. Another type of bond, a municipal bond, can be free of federal, state, and local income taxes, depending on where you live and if you hold that municipal bond until maturity. But they can be subject to state and local taxes under certain circumstances. So, Carrie, I hope that is helpful. If you are looking to reduce taxes in the current year, you definitely need to make contributions to a traditional retirement account, but don't count out all of the great benefits of a Roth. Even though you do have to pay tax on those contributions in the current year, you get some incredible benefits if you hold that account over the long term. All right, let's talk about our second question, which came from Jenny. She's asking about what will happen to her and her fiance's ability to make Roth IRA contributions after they get married. For 2024, the contribution limit for a Roth or traditional IRA equals your or your spouse's earned income up to $7,000, or if you're over 50, $8,000. Unlike a traditional IRA, you can only contribute to a Roth IRA when you earn less than an annual threshold. And the limit does depend on your tax filing status and your modified adjusted gross income, or MAGI. So let's go through the 2024 income limits to qualify for a Roth IRA. If you're a single taxpayer, you must have a MAGI of less than $161,000, but you do qualify for a reduced Roth IRA contribution if you earn between $146,000 to $160,000, and you can make a full contribution if you have a MAGI under $146,000. If you're married and you're filing jointly, you must have a MAGI of less than $240,000, but you're going to get a reduced contribution amount from $230,000 to $239,000. And both of you in the couple can make a full contribution to a Roth IRA when you have household MAGI under $230,000. Now, if you are married but you're filing separately, you must have MAGI of less than $10,000 to qualify for a reduced contribution. So this is really not going to favor you, being married and filing separately. However, for your first year, you can use the single limits. So, back to the first limits I talked about, the single taxpayers, you can use those limits if you have not lived together in the past years. That's kind of giving newlyweds a pass on the first year that they're filing taxes. So definitely, Jenny, I would definitely think about, really comparing filing together versus filing separately. In a lot of cases, you're going to come out ahead filing jointly. So, you might want to ask an accountant about that if you're not sure. But if you have a Roth IRA and you become ineligible in the future for whatever reason, you can keep your account indefinitely and enjoy its tax-free growth. However, you can only make new contributions in years when your income is below the annual allowable limit that I just reviewed. All right, let's talk about our last question, which came from Lisa. She is asking how to get the most tax benefit from her medical expenses after she drains her FSA. Now, if you're not familiar with FSAs or flexible spending arrangements or flexible spending accounts, they're the same thing. These are medical savings accounts offered by some employers. Eligible employees can make pre-tax contributions from their paychecks to an FSA to pay eligible health care and even dependent care expenses, depending on the type of plan you have. You decide how much to put in the account up to an annual limit. And for 2024, the FSA contribution limit is $3,200. The deal with an FSA is that you've got to spend all your funds annually, or you forfeit them back to your employer after a short grace period, which is known as the use it or lose it rule. Now, in most cases, you cannot contribute to both an FSA and an HSA in the same year. But, for those who don't have an FSA at work or choose not to use it, using an HSA is an excellent way to pay for many healthcare expenses tax-free if you have a qualifying health plan. And I've done a bunch of podcasts about HSAs, so definitely scroll back in the archive if you want to learn more about them. Many healthcare expenses can be claimed as a tax deduction on your tax return, which reduces your taxable income if you itemize your deductions on Schedule A. So you do have to itemize deductions in order to take advantage of this tax benefit, but I think it's well worth it. And you certainly should compare itemizing versus not itemizing, and using whichever method gives you the lowest tax liability. For 2024, your eligible unreimbursed healthcare costs that exceed 10% of your adjusted gross income are tax deductible. And if you or your spouse is 65 or older, you can deduct expenses that exceed 7.5% of your adjusted gross income, and that applies through 2026. So let's say you're 45 years old and you have an adjusted gross income of $100,000. And maybe in this year you spend 5% or $5,000 on qualified healthcare expenses. In that case, none of those expenses are deductible because they do not exceed 10% of your AGI. 10% of your AGI is $10,000. But let's say your total healthcare expenses were $12,000. Well, in that case, you could deduct $2,000 of them. So that's the amount over 10% of your AGI. So you need to remember that not all of your medical expenses are going to be deductible simply because there's kind of this, high bar that you have to meet, this 10%. And it could make sense to kind of batch your medical expenses together, kind of grouping them together in one tax year in order to make it as large as possible so you have more of an opportunity to deduct them. And if you're wondering, well, what are deductible healthcare expenses? Well, they must be necessary to prevent, diagnose, treat, or alleviate a medical condition. And those expenses can be for you, a spouse, and your dependents. You can deduct healthcare costs the year you pay for them, regardless of when you receive those medical goods or services. So let me take you through some examples of potentially deductible healthcare expenses. It's going to include fees to doctors, chiropractors, dentists, psychologists, and psychiatrists, hospital or nursing home care, prescription drugs, eye care, including exams, eyeglasses, and contact lenses, hearing tests and aids, medical equipment like crutches and wheelchairs, transportation to receive medical care, including ambulance services, fees paid for acupuncture and Christian Scientist practitioners, treatment for alcohol or drug addiction, including transportation to local prevention meetings, fertility treatments like in vitro fertilization and pregnancy test kits, lactation supplies, vasectomy and abortion procedures, home modifications to accommodate a disability, owning a guide dog or other service animal, smoking cessation programs, and health insurance premiums, unless they were already excluded from your gross income by an employer. Now, that is not a complete list by far. You can review hundreds of deductible healthcare expenses in IRS Publication 502 called Medical and Dental Expenses, and I'll put a link to that in the notes for the show. I want to note that if an expense is a tax-free benefit, if it is reimbursed or paid for using an HSA or FSA, it doesn't qualify as deductible for your tax return. That would be like double dipping if you paid for it with an FSA and you tried to deduct the expense on your tax return. You can't do that. Nor can you deduct expenses like cosmetic procedures that are unrelated to a medical condition. You can't deduct health club memberships, teeth whitening, or funeral expenses. So remember that you can reduce your taxable income and taxes by carefully documenting your eligible healthcare expenses throughout the year. You want to remember to maximize contributions to a workplace retirement plan or an individual retirement account to reduce taxes. These are just a few ways to cut taxes and keep more of your hard-earned income. If you've got tax questions, I definitely recommend consulting a tax professional for clarification and help filing your taxes. They can help you get every legitimate tax break you're entitled to and save even more money. A big thanks again to Carrie, Jenny, and Lisa for sending in your questions. And before we go, I want to just remind you, this is episode 840, which means there's so much more Money Girl for you to explore in previous episodes. Also, make sure you're following me on Instagram and the Money Girl Facebook page. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our amazing team. It's audio engineered by Steve Rickyberg. Our director of podcast is Brandon Gachus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. And our marketing and publicity associate is Davina Tomlin.